Rosehart show. We're live again for another episode, and today things just got a whole lot worse. We have some new data coming in on the real estate side. We have some new data coming in on inflation side coming soon, and we have some data coming in on jobs reports. We have some earnings from some of the top, what do you call them, headhunting and recruiting and just online job posting websites to see really what's going on in the world. And it is not as great as the big tech would like you to believe. And I think it's going to be some ramifications in the real estate space. Just in general, we have a lot of headwinds ahead. And I think we need to be careful about getting too excited about some of the valuations on companies right now, especially companies like NVIDIA. Pick anything from the NASDAQ 100 right now. Most of those companies, I think, are a tad bit overvalued given current conditions that we're going into, given that gas prices and oil are starting to surge again, given that, employment is starting to slip. There's a lot of people who are unemployed that are claiming that they're just not reporting that they're unemployed. So the unemployment is actually much worse than it looks. So we are probably in 2024 headed for a recession. In the real estate space, all has gone quiet on the Western Front, and it is, so to speak, as a realtor on the ground, talking to the realtors on the ground, things have gotten really, really quiet. And sorry, just me. Whoa. I have my white light on by accident. I think I usually have my yellow one. What do I normally have on? Does this look normal? Sorry, my hair's all wet. I was out in the rain working on my pool shed and my pool project, and so yeah, that's why I'm soaked, because it started raining midway through working and got rained out, and then I came in. I was like, oh, it's Wednesday. I got to run inside and do a little show. And luckily, I had prepared myself to do the show. And last night, I was thinking about what am I going to talk about today, and things have gotten worse. And they continue to get worse. There's a new stat that just came out that here in Ontario, cottages, so we're talking about all the cottage recreational properties, vacation properties, Airbnb properties, between 5 and 60% drop in valuation in the last year. In some pockets, a 60% drop in the price of real estate in some of those cottage pockets. So pretty crazy. Anyway. There we go. Hey, how you doing from Alberta? Good to see you again, David. And Port City says, what's up, sitting on capital like a wolf in the woods. There you go, ready to pounce on prey. The opportunity is coming. I think it's a good time to start buying the dip. The reason I say that, and the reason I'm starting to throw out a lot of offers, is just because no one else is and no one else can. Our prime in Canada, if you go to the bank right now and open a home equity line of credit, secured against your house, they'll lend you at prime plus a half usually. So prime plus a half is about, our prime is at 7.2 at all the major banks in Canada. And we're talking about 7.7% on your HELOC. Most lines of credit's at 9 or 10%, or higher credit card debt at like 20%. We are at $1 trillion in personal debt, which is growing at 20% a year. So we'll be at 1.2 trillion soon. It's building, and people are not paying off debt. If you look at the balances, what you can see is that people are actually not getting out. They're actually growing their balances every month. That's a bad sign. What happens is the people first start getting tight. They don't cut their housing first. They'll cut, their cottage, which is what we're seeing, 5 to 60% drop. They'll cut their Airbnb property. They'll just sell it off. They'll sell their fancy car. They'll max their credit cards out. They'll draw their lines of credits down. And at the last second, that's when everything else is maxed out, that's when they'll go to sell the house. So we will have an opportunity to buy. In the commercial space right now, try getting financing at prime plus 1 on commercial debt right now. I'm talking about malls, industrial, office, retail. You're borrowing at 8-9%, and most of the cap rates in the major cities are 4 and 5%. And now we're talking about inflation resurging, meaning this might be a battle like the 70s for half a decade or a decade. If that's the case, and we battle at higher inflation, one, asset prices over the long term will degrade in buying power, so they have to keep up with inflation. So if you're levered and you can get cheap debt, you're going to make a lot of money through this. But if you have expensive debt through this, in the short term, when you go through high leverage, the government has to crush demand to fix supply side issues. They can't really control the supply side, right? And yes, Grind, I just saw your message pop up. I am short the NASDAQ. Hell yeah, 388 on the QQQ, down to now we're in the 368 range. It's great. I've been enjoying it. I've made multiple 6 figures on that. I'm going to see that short through. I'm going to manage it until a point where I've already started cutting. Actually, I've put in orders now to start cutting the short. I do think things will get a lot worse before they get a lot better. But remember, buy the dip. Over the long term, you'll always win. Don't try to time the market as I have done. I'm just seeing this short through. The NASDAQ was up 43% in a 6-month period. That's irrational. You know, you don't have like Microsoft, Google, Apple, all these tech companies, Meta, whatever. You don't jump 100% in valuation as inflation is at 20-year highs, as mortgage rates and interest rates are at 20-year highs. Your discount rates on future cash flows should be reduced. Your valuation, you can't assume next year rates are back down to 3%. It's just probably not going to happen. It's a we'll call it a rosy situation, the rosy Rosehart situation, the best of the things that can happen to happen. And I think a lot of people are expecting that, right? Thinking AI is going to deliver more than it really will, in terms of cost reductions, in terms of revenue generation. Just like with the personal computer, it did revolutionize things in the internet. It changed things, just like in the dot-com bubble, but it doesn't change things as fast and as well as we'd like to expect. So over the long term, AI is a really great trend to invest in. I'm actually going to make some bets on AI into the future, and I want to ride that wave because I think it's going to revolutionize like the industrial revolution, the way that we as humans interact with the world and the way our economy currently works. But it's not going to happen overnight. And the valuations, I think, are too rosy and too frothy given the economic conditions. All we need is one or two, bad inflation reports, which are coming, like very, very high probability that we will see that happen. It's one of those things where I think, hello, I'm going to catch this question. It's one of those things where I think that people think that inflation is beat and inflation isn't beat. And it's one of those things where people think that, everything's just fine, and it really isn't all fine. Okay. David says, what is a good rate for a new secured line of credit in today's world? An unsecured line of credit, like I said at the start, luckily I answered that question for you, but you're going to be looking at Prime Plus, and Prime's at 7.2, so Prime Plus 1, Prime Plus 2, they're looking at 8, 9, 10%. That's every single business mortgage, business line of credit, unsecured personal lines of credit, also commercial loans will be in that same range. If you're lucky and you're securing your personal primary residence, you might get Prime. I think I'm at Prime on my HELOC, but it's, again, like that's like the best you're going to get typically. What's up, Mike? Stay on my capital like a wolf in the woods. There you go. House stooping listed way over price. These realtors are really some sons of guns. It's not really the realtors per se. It's more like homeowners. And I was looking at the data, and I shared this on my stories the other day. Days on market is increasing. If you look at the last few months, days on market is going like this. We have beyond just days on market being up, so if days on market up, we've got average inventory is up. We've got so supply is growing, and what we're seeing is and price is starting to fall. What we're seeing is that like someone, let's say your house, you had your house appraised at the bank, and the bank came in and told you, an appraiser came in and told your house worth $800,000. It's really hard for someone, even an investor, to go a year ago in the frothy of like February, March 2022, year and a half, whatever. Now in the summer of 2023, it's like, hey, your house is actually worth a quarter less than it was before. If it was worth $800 before, it's now worth $600. And by the way, if you put a mortgage on it, you have no equity in your house. So why would you sell? You get nothing to sell it. And most people are levered to the tits, especially anyone who bought in the last 5 years. So that's the real situation. It's like, why would they sell when they get nothing out of the property? They've lost their entire down payment because leverage makes a 20% drop equal 100% loss of your entire invested capital in your down payment. And so that's the real challenge right now, is that as a realtor, talking to people and like on the ground, I'm not really a realtor. I am a realtor licensed, but like I mostly buy and sell my own houses. I don't really work for other people, but I talk to other agents who do. And the word on the street right now is that like sellers are still a little irrational. And buyers are trying to negotiate really good deals, as they should, because there are very few buyers who can afford to qualify. Do you know the income you need to qualify for a house in Toronto? $700,000 a year unless you commit mortgage fraud. To get a nice average $2 million house, to qualify for that, you need $700,000 a year in income. If you have a couple dependents, whatever, and maybe around the property, you got a supporter or a cottage. Like you need that to have that kind of income. Even a doctor can't qualify. A lawyer can't qualify. Like you need insane amounts of income to qualify with these stress testing rules at these rates. And it's done to protect the system, whatever. But like the buyer pool is very small unless they have cash. And most of the cash is being sucked up. There's a lot of printed money in the system, but again, it's being soaked up in various investment opportunities. When there's a lot of opportunities pulling for you at once, the buyer pool is gonna, the capital is gonna flow out. So there isn't as much as there was. And that's just a fact of what it is right now. A little off topic, do you have any mortgage folks you work with you can point me to? For sure. Yeah, I mean, there's lots of mortgage people, lots of mortgage brokers. There's like dozens of mortgage brokers you could talk to, and they have B lenders too that they could. There's lots of guys who recommend different B lenders, but yeah, you're gonna pay. I mean, the truth is you're gonna pay 10%, 9-10% interest right now for a B lender. So ideally, if you have good credit, you can get A lender, better, but I can see situations where you need B lender because it just saves you time. If your time's high value, you can do 2 deals in the time it would have taken you to go through financing on A lender. So going B sometimes will pick up extra points. On a $300,000 mortgage, that's $3,000. Who cares? $3,000 for the year. If your time's worth $500 an hour, that's 6 hours of your time. And the financing might take you 20 hours of your time. So it's actually cheaper overall to spend your time more efficiently and to just pay more on the interest rate and go with the B lender because it's easy and you can use that time to do more deals. So I can definitely see the argument for that. Joseph says, hope you and your family are well. Do you think it's easier to invest in real estate back when you were at the start of your journey compared to the market today? So, Joe, I think it's different. It's not necessarily easier, it's different. Back in the day, house prices were lower, rents were also much lower. Like I would rent a bedroom out for like $400, and now you can rent a bedroom out for $800. So rents are double. And so when a property was $400,000 then, now it's like $700,000. It's the same. Like the rent to price ratio is very similar. So in that sense, it hasn't changed all that much. Like back when I started investing, a bachelor would rent for $600 a month, and now a bachelor rents for $1,400 pretty easily. So rent's more than 120% higher. And it's one of those things where it's different, but it's not harder. I would say it was really hard in 2022. It's now in 2023 and into 2024, just like when I was getting started, because there aren't a lot of buyers. You can negotiate really hard. You can get seller financing, vendor financing. You can definitely get in there and negotiate in ways that you couldn't before. And prices have fallen 20 to 25%. In cottage country, in some areas, you've seen a 35% drop in value. A third of the value of the real estate in Ontario, gone. I mean, that's substantial when rents haven't dropped at all. If anything, rents are still climbing. So that's interesting, right? Like what's happening is people can't afford to buy anymore and they're just renting. So rental demand is actually increasing right now. Cash flow is increasing. Now rates are high. So if you can weather this storm and you can buy an asset for a 30% discount, you're going to be paying more in a monthly payment. But if you go variable or you go 2-year fixed, 2 years from now, you'll have had that asset. You got a third of the value wiped out off it. And you're now left with this really awesome opportunity to get this asset cheap. If you can weather the storm of maybe no cash flow because rates are so high right now, then in 2 years, you're in a really good situation if rates do come back down, which I think that they will. I think probably they'll continue to crank until they break something. They have to keep raising rates until people capitulate. The market has to capitulate. Real estate has to capitulate. Business owners have to capitulate. And when there's pain and unemployment, then they'll stimulate again. But they need to anchor expectations around inflation. And people currently, if they did a survey, I was reading a report on this is the scary thing, is that inflation is becoming unanchored in people's minds. People are expecting inflation. Business owners are building it into their prices. The average consumer, if they expect inflation to be more than 2%, it will drive inflation at a rate faster than 2%. So it's all about expectations, and they need to set them. And in order to fix the market, fix inflation, they have to break the market. They have to break the economy. This idea that you can somehow navigate through, I mean, it's possible, but very, very unlikely. It's put it this way, in 200 years, it's never happened. So it would be the first time in history, if it does happen, that we are able to beat down inflation, rise rates this quickly, and not have a recession. I mean, it's possible that somehow we have full employment. More likely than not, it's going to be we have full employment. People aren't unemployed. Everything's fine because they're massaging that equation. But really, it's just a bunch of these guys are, like the old project managers that were working at Meta. They're making $250,000 a year. They're unemployed right now. They all got laid off, but they're not being accounted for because when they send in the survey, they don't put unemployed. They put currently working on a side project or whatever. And so it's underreporting how much unemployment is actually there and how much people are actually suffering right now. And so I think they're going to go too far. I think it's going to cause some pain. And the data seems to support this thesis finally. And I've been calling for it since so I went short. I was long the market in January. I had Intel, Meta. You guys remember in December and January, I was super long tech. Valuations were great. Meta was trading at a 9 price to earnings ratio. And it's one of those things where, it's just, I don't know how to put it, but there was just, I lost my train of thought now. I saw this question pop up. How are you doing, Jonas? No, please don't. No, I'm not gonna get a haircut. I actually like this. I like my hair long, to be honest. I actually am really enjoying it. Even when it's wet, yeah, I like having long hair. I enjoy it. For now, I'm gonna keep it going. But I am due for a little bit of a haircut. Sorry, to answer the second part of, what was the question I was trying to answer before? I lost my train of thought. Basically, the data, is now finally supporting a pullback, and I'm short the market for that. And of course, I continue to buy the dip in real estate, so I will continue to do deals. There will be some deals that I do in this next period if things go worst case scenario, where I may lose money. And that's okay, because if I can hold that property and be cash flow neutral or cash flow positive for a 3 to 5 year period, you will always win. Over the long term, if you buy quality assets, you can't lose. So that's where I'm like, buy the dip, guys. Buy real estate properties now, negotiate great deals. You can probably negotiate 25% off the value of a property today versus its appraised value in a year ago, this spring, here in Ontario. Less so in some of the states right now, but there are ramifications to what they're doing, and where there's gonna be opportunity. So if you can get cash together, super valuable in this time. Okay, Joe's question. I guess circling back to answer that, I pretty much did answer whether it's easier now. In some ways, it's easier now than it was then, only because, again, there's just, and maybe it's because I know what I know now, but I think if I had to start again today, I would do it so much better than I did before. I'd be so much richer today. Like, I started in 2012, so that's 11 years ago. When I started 11 years ago, it was a different landscape, but in some ways it's better today than it was then. There's definitely, I don't know. In some ways it's also worse. Like, I can see on the con side that salaries haven't kept up with the price of real estate, as an example. It's dramatically out of whack. So, I mean, where I had a $60,000 salary, and that was 10 years ago, or I guess, no, that was 8 years ago, when I was working, I was able to, use that to buy properties. There were $300,000 properties. You can still find those properties today, just shittier properties in worse areas of London, and you have to go outside of the main city, which is fine. You can still find deals to fund, but it's harder to qualify. However, back then, the rents that I could use to help qualify were so much lower. So you can use the rent in the rental property to help you qualify for that mortgage. So in some ways, there is still a play. It's not like real estate's dead. There's still an opportunity here. And if anything, I mean, last year was a shitty time. It's getting better, actually. Buying the bottom is kind of great. So I'm optimistic still. And again, I am bearish, but I'm very bullish in the long term. I might be short-term bear, but you can't be a long-term bear. It just doesn't work. The market always goes up. They've designed the system so that we have inflation, meaning your buying power is decreasing, meaning your asset values are all increasing. So if you apply leverage and you're able to leverage with inflation, leverage is super sexy. So when you can go borrow at 3% and inflation is 5%, your cost of debt is negative 2%. Your mortgage payment, they're paying you to borrow. Every year, the money you have to pay them back is worth less. So it's a net win. And so that's something to be cognizant of, guys, in these times. And when you're thinking through how do we play this? Well, trying to get together resources and start buying the dip. It's hard to know when we're in the dip. Pain will be maximum. You'll feel like there's so much more to go, but when you look around, there's blood everywhere in the streets and there's real pain. That's when you go and buy. And you keep buying. You deploy 25% of your capital, another 25% of your capital. You keep deploying. You buy the really great deals all the way into the bottom. And then on the way up, you'll be so thankful that you did, because it moves like this. And we're now in another little bit of a down cycle. We had a huge rip up. That's going to crack down. Whether we'll get a real bottom like we had in the fall, I don't know how low it's going to go in the stock market. I don't know how low it's going to go in real estate. It should be much worse than it was in the fall, right? Back in the fall, there was still optimism and hope and capital. And it was by 2023, rates will be back down and it's going to be okay. And now it's sort of settling in. Hey, we've had inflation high for more than 2 years now. It's not transitory. And they're having a really hard time kicking its ass. And if we get a couple of spike reports and we say, hey, we're not at the bottom and inflation is trending up, shit is going to hit the fan. We will see a 10% drop in the NASDAQ and S&P 500. We will see over a month period of time. We will see real estate prices probably fall another 5-10%. In Ontario, they've bottomed quite a bit. So there's a real possibility here for opportunity. But if you buy for cash flow and you buy the way that we talk about building a business around real estate, then you're fine because you're going to operate your business. You've already factored in sensitivity analysis. If things go up or down to the price, you don't care what the price of the property does because your rents are stable, your cash flow is stable. You've got a plan, right? It's a business and we don't speculate. The speculation is a bonus. We try to buy areas that are going to appreciate and value better. But just in general, yes, that's my sentiments. Okay, we got to end bidding. Why can't we see other offers? So blind bidding, you're talking about that. That is coming actually. To Ontario, there is new legislation coming where blind bidding is going to be gone and they will be allowed to disclose. The seller, the way it's currently written is now the seller will be able to disclose whether or not they want to share the price. And so it's like, why would a seller ever do that? Because it's always in their best interest to to have it be blind auction, right? For whatever. Can't wait for a Trump bump MAGA. I don't know. Honestly, I think Biden's an idiot. So anyone, to be honest, anyone is better than the Biden administration. The guy is the most corrupt retard I've ever seen in my life. Like, for politics aside, he's not fit. He's like battling dementia. He literally can't even string a sentence together. He's just a puppet. The guy's so old. I feel so bad for him. Let him retire and sniff some children's hair and have a good time. Let him retire. He's been a career politician for 50 years. Like his whole life, he's been, doing backdoor corrupt deals and just, he flip-flops on topics and issues. I can't imagine a worse management for the United States of America than Joe Biden. But whatever. I mean, who cares? It is what it is. I don't really get into politics all that much. It would be great if Republican, there's some Republican candidate that won, whether it's Trump or DeSantis or whoever. It's better, I think, overall as a business owner. I stand to win. It's better for the country in general. It's better for the people over the long term. Socialism and communism don't actually play out the way that most of the socialists and communists think that it will. Capitalism works really well when you put some regulation parameters on it. Because a lot of people are like free market, whatever. Capitalism works really well when you put parameters. Because there are pieces of shit out there who will sell you snake oil and kill you to make a profit. So there needs to be a stick there for those people who will just kill your cousin for money or like kill their own parents. Like there are some crazy people out there. And so capitalism fails when you don't regulate for those people who will literally like blow everyone else up for their own personal gain. But it does work when you incentivize people, and capitalism does a really good job. I guess it's like a version of capitalism where there is regulation. And so again, I think the system works. It's a meritocracy. Those that do what they're supposed to do, they follow the rules, they build the businesses, they follow the steps, they put in the effort, they get the reward, they get the result. You don't put in the effort, you don't get the result, as it should be. There should be a bottom standard for people, but anyway, politics aside, that's what I think. So, Honda, how you doing? First time here, hair looks good, man. Thank you. I've been growing it out for like a couple years since COVID, and I like having long hair. I look better with short hair for sure and not having a gross grizzly beard, but the whole point of financial freedom and financial independence is like, I'm not accountable to anyone. I have no boss. Even my customers, I don't care. Like, hire me, don't hire me, partner with me, don't partner with me. There's another partner around the corner. Obviously, anyone who's currently partnered with me doesn't give a shit whether my hair is long or short, as it should be. And so I'm glad that I have built that luxury in my life. I'm thankful for that. Port City, yeah, Meta is up over 100%. Great comment. Yeah, Nvidia's up 200%. Meta's up, over 100%. A lot of these companies are up between 30 and 100% year to date. That is an insane amount of growth. The market priced in a Fed pivot on rates coming back down, and they priced in inflation going back to 2% too soon. And that was irresponsible. And on top of that, I think the tech market has currently priced in too many gains from AI, too many cost reductions, and too much additional revenue. It's going to take a long time. We're going to get there, but it's going to take time. The valuation of these companies right now, We will hit these levels in the future, guaranteed. There'll be new highs from where we are now. They just haven't earned that value yet. So it's overvalued. At some point, people are like messaging me like, oh, NVIDIA's gonna be worth like, they're easily $1 trillion company, and like all these companies, $2 trillion, $10 trillion companies, and like, that's great. And like, I can see the path there, 50% growth for the next, 5 to 10 years, and no competitors come in and eat their lunch. That might happen. It probably will happen with enough time, but they're not there now. So don't pay 5 years price now. Don't pay too much for growth now. In real estate, don't pay for speculation. Pay for cash flow. Pay for what there is. If the tenants are paying $800 a month in rent, I see a lot of investors offering saying, oh, this could be $1,400 a month in rent. That's the market rent. Great. That's great that it's market rent. Good luck getting a tenant out in Ontario. Even if you could, it's a battle for a year. Even in landlord-friendly states like Florida, it took us almost a year, like 8 months, to get a trial and kick out a squatting bum who is paying nothing. That's when you have landlord-tenant rights in your favor. It takes 8 months to get a trial and to get them kicked out. So, I mean, it really isn't, a lot of people are factoring in no value for that work. And I look at like replacing a tenancy and changing over a unit is a lot of work. And so there needs to be a huge lift there for you. Don't pay that price, what the property's worth when you change it over. Don't even pay half. Pay what it's worth now and unlock all that value for yourself. That's how you build a business around real estate. And that's how I've made so much money over the last 11 years, is like being true to my numbers. Just stick to your numbers and you'll be okay. And this dip's gonna be a great time to buy. Yes, this is a troll comment, but I'm gonna read it anyway for fun. My friend bought a pre-construction at the top of the market and it's halfway built. His insurance amount is more than its current price. Would you recommend burning it down for the insurance payout? So a bunch of houses in the greater Toronto area right now have burned down. There's like, apparently the number of fires is up like 500% or something. Just as like a random factoid we can kind of play with. So people are doing that. Builders, developers, they're going bankrupt. A lot of builders, a lot of developers going bankrupt. Builders have really tight margins, and so do developers. And in down markets, developers go bankrupt. So just be careful, guys. Most developers and builders go bankrupt, especially the small guys, during recessions like we're going into. So be careful when you crunch your numbers if you're lending to them. And in general, look for opportunities. And if you're going to be a developer, don't right now, maybe. Look for a development play. Or if you're going to be a developer, look for a development play that currently cash flows. Buy an existing apartment building that you want to tear down and do something with. And over the next 3 years where you're rezoning it and fighting with the city to do what you want to do, it continues to cash flow and pay your bills. That's a great development play. Don't buy a raw piece of land you got to put money into, or buy some old houses you have to maintain and you can't rent out. Anyway, do what you're going to do, guys, but that is a recipe in this market for bankruptcy. And that's why I stick to cash flow properties. I don't ever dabble in development. I try to avoid building too. If I'm gonna build, I build on I add on to an existing. I put an accessory dwelling unit while the main house is cash flowing for me. I find ways to value add where I can cash flow. All of my properties, if I had to hold them, can cash flow. And so that's nice. I like that, like, worst comes to worst, I can at least break even on all of my properties. I don't have to sell anything. Some developers and builders, they have to. They're sitting empty. They have no option. You don't want to be in that position. Speculators get burned. Hogs go to market and pigs get slaughtered, I think is the saying. Don't be a pig. Or is it the opposite? Whatever. The saying is, don't be greedy and don't take on, being speculative is being greedy, right? The hard work is renting a property out and collecting the cash flow. The easy thing is buying it and holding it for appreciation, or a development play with no tenants. It's like, that's so easy. Well, easy is going to get you slaughtered. Do the hard work. Don't take the easy road. Bow, bow, bow. What do you think of the current Liberal NDP coalition will fail? Well, currently like 80% of Canadians don't support Justin Trudeau in a recent survey I just read. So 4 to 5 Canadians don't like him. But my sentiment is the same politically. I think that Canada is a beautiful country, has so much potential. It is poorly managed, very poorly managed. Some of the worst management in the G20. Unfortunately, our Prime Minister literally is quoted saying like, budgets balance themselves. I don't think about the economy. I have a math issue, so like I don't worry about the numbers. Like, he's literally a fired drama teacher. Couldn't even hack it as a teacher. He's the only Prime Minister in our history who's not had either a master's in economics and a law degree. Every single prime minister in our history before was a lawyer with a master's LLB in law, or a JD, which is a law degree, a Juris Doctorate, or they had a master's in economics. He's the first unqualified, the most unqualified. And his issues he's concerned with are like LGBTQ rights and like going to see a Barbie movie. Like, what? The things he cares about. It's like, through COVID, I lost all respect for them as a party, and Jagmeet's no better. He's worse. A lot of these guys pretend they're there for the people, and to be honest, they're there for themselves, right? They're there for their own pension, their own ego, and their own trust funds, and it's fucked, but that's humanity. You know, people are out for themselves. That's why we need regulation, and we need people to band together. Dean says, love your content. Been following a long time since 2016 when I met you at Infotech. Cheers. Thanks, Dean. Welcome to the stream. Thanks for tuning in. Facts, someone said here. I think I got all the questions kind of answered. Honda says, my work has been shut down for 3 weeks. I feel like fighting cross-dressers. What? Okay. David Jagmeet wants that 2025 pension. There you go. Jonathan says, Mike, do you have videos on how you traded stocks and were successful? So Jonathan, I've had really bad, this is like almost funny, but like it's really not funny. I've had horrible, horrible losses the last year. I shorted the market 2-to-1, the NASDAQ 2-to-1. And the NASDAQ ripped 45% up. 2-to-1 means 90% loss of your account. However, I ran the wheel. So I used, basically I ran the wheel in reverse. So I sold calls and then I would use puts when I got assigned to get rid of it. So the theta decay on those option contracts allowed me to go from a 90% loss to like a 45% loss. So I was able to negate some of that. I wished I wasn't so short and so wrong on my thesis. What I should have done is to play neutral. If I had not been long or short and just ran the wheel and stayed with an equal amount of longs and shorts collecting theta decay, I'd be up like 30% in the year. So it's a shame that I got greedy. And again, when you get greedy, you can get slaughtered. But all the data at the time, again, like I was long into December, January, I longed tech. I was short in bits and pieces in 2022, but 2023, I was long. I started the year off long. I was up 25% on the year to date. And then I started shorting in the start of May or end of April. In April sometime, I started shorting. And I started shorting hard. And I doubled down again into June. Start of June, I doubled down. And so hopefully that will play out and I'll be fine. I'll get out of that. I will never short the market again. This is the last time. I don't even care about being right anymore. And I am right and I will be right probably. But don't try to time the market. Buy the indexes. Run the options wheel in the long direction. I had a lot of success in 2021, 2022. Again, I bought dividend stocks. I was very careful about running my wheel. I held only quality names. That portfolio did really well. I made over $1 million with that. So that was great. I was doing really well with that. Crypto, I've only ever lost my shirt. I tended to buy the top and then sold the bottom. So hopefully that works out in the long term, holding some of those crypto plays. But I was a phenomenal trader when I didn't pick a direction. I was doing really well with, and I'm not a trader really, because I wasn't doing daily stuff. It was like, I was good at putting positions on when things were extreme red and extreme pain. And I was good at cutting when there was extreme, euphoria. And so I'm good at taking profit when a lot of people aren't. They get greedy and let it ride and they lose it all. So that was one thing I was good at. But again, I don't enjoy trading. Trading is a lot of energy and effort. If I spend the same amount of time in my real estate business, I make $1,000 an hour. If I spend 3 hours a day, that's $3,000 a day. That's $1 million a year. And there's no risk. When I do a coaching business where I'm coaching people through real estate or I'm doing real estate deals, there's a lot less risk than where I'm trading. So for me, my time is best spent. And I honestly, the stress of the down days, like once a week, you'll have a really bad day where like you make bad trades and you're like, fuck it, I'm done. You cut yourself off and you're done for the day. The whole day, my life is ruined for that like 12-hour time span. All I can think about is how shitty I was at placing those wrong trades and being wrong on the timing. And I'm thinking, I could have done better. I could learn from that. It's not productive. So for me, trading isn't a good fit. A lot of people are good traders. Cool, have fun with it. If you enjoy it, it's an expensive hobby. It can be a very expensive hobby. It's not for me. I'd rather be an investor. An investor can walk away for a month and not check their portfolio. That's how you know you're an investor. You're in quality companies. You can walk away for 6 months and it's okay. You're diversified. You have no more than 1% of your portfolio in any one stock, which means you have at least 100 different positions in your portfolio, but you rebalance annually. That's safe. Many countries geographically invested. You want a piece of the market. It's good to be in a little bit of every market. It's not so good to be heavily concentrated in one area. And I think that there's some real value in having a stock portfolio, again, because when you're going for real estate financing, the stock portfolio helps you to borrow. So that's where it really is complementary in that sense. And the diversity is also great too. If real estate is in the shitter, if you have a $1 million stock portfolio, you don't care, right? They're not always correlated. Sometimes real estate could drop while the NASDAQ rallies, as an example, right? Anyway, does adding a pool increase your insurance? Good question. I'd have to call my insurance company and find out. Probably yes. What got worse? So if you watch the start of the video, I talked about some of the things that got worse throughout this video. There's several indicators that have allowed us to be more clear on our thesis about the inflation resurgence, rates staying higher for longer, and ultimately the pain that ensues in businesses and real estate as a result of that into the end of this 2023 and probably into 2024 as well. So pain is incoming, and some new data continues to support that thesis. The pain is coming, that we're not going to land this plane, so to speak, between the rock and the hard place, which was the current market prevailing thesis, I think, up until recently. I think I got all the questions here. Plan on watching content. I mean, yeah, I think trading stocks, be careful. So I'll just leave this bit of data with you about trading stocks. The majority, 99% of retail traders lose to the S&P 500 over a 10 to 20 year period. And then 99% also of professional hedge fund and active mutual fund trader, like anyone who works in Wall Street, Bay Street, the best of the best, the PhDs in finance, the guys who do this for a living, who have all the insider information with the Bloomberg terminals. Net of fees, 95% of those guys don't beat the market. So if the best on Wall Street with a Bloomberg terminal, access to staff, all of the information, and they're spending 80 hours a week, like they're in at 6 in the morning and they're not leaving until 7 or 8 p.m. at night, every day, including Saturdays, doing research, whatever. You're competing against, in the stock market, you're competing against them as a trader. If you buy the whole market, you're not. You're investing with them, so you can win. You could take a portion of your portfolio and invest in some fringe things like maybe AI or whatever, and you could outperform the market. But over a 25-year period, they don't, and you're competing against them. And it makes sense why you can't beat them, because they're working harder than you, and they're smarter than you. And even if you are smarter, they're going to outwork you. If you have a full-time job, good luck. If you want to be a full-time trader and you want to put in the hours and you want to put in 12 hours a day, you want to put in the 80 hours a week it takes to be as good as them, as sharp on your game, to develop what is called alpha. Alpha is your edge in trading. If you want to develop that edge to beat the house, to beat the other people you're betting, because whenever you take an options contract, someone else is taking the opposite bet of you. You go buy a put, someone had to sell you that put. So someone took the opposite bet of you. And what do they know that you don't? And so that's something to think about when you're trading options or trading stocks in general, is who's taking the other side of that. Whenever you short a stock, someone else is buying it. If you're buying stock, someone had to sell it to you. And what do they know that you don't? And how is your edge or alpha better than theirs? And the data shows, by and large, the majority of traders in active funds don't beat the market. There are a select few that do. Are you that? And even if you could be, do you want to be? I don't know any Wall Street guys that have a life that I would trade for. And I know guys making $750,000 a year, $1 million a year in private equity that I went to Ivy with, and other people I've met along the way. I don't want their life. They might make $1 million a year. I don't want their life. It's shit. They have a shit quality of life. So being a trader is high stress, shit quality of life. So it's like not even something you want to aspire towards, I don't think. And then if you're not going to aspire towards that greatness, don't do it a half-ass, because you're going to get your lunch eaten. What I think you could do is run the options wheel maybe on the S&P 500 in the long direction. And as long as you're always playing long, you'll be okay. And if you're going to use leverage, you're going to apply leverage to your portfolio, please, please, please buy yourself some puts to protect yourself, or at least sell covered calls in your positions as insurance against pullbacks. Because with leverage, you can get wiped out to zero. I'm a perfect example of that. I like to think I'm a really smart guy. I don't put enough time in. I was taking bets against people that I shouldn't have. The market is always right. And I would, even if it may take a year to be right, but I can get wiped out. The saying is you can't stay liquid longer than the market can stay irrational longer than you can stay liquid. So it can do whatever no data supports longer than you can. So anyway, guys, that's it for the stream tonight. Thank you everyone for watching. I appreciate everyone who tuned in. Jump in the comments, smash that like button right now. If you're still watching this, the thing you have to do is like, I just got off the stage right now. Like I'm off the stage, now you clap. The way you clap on YouTube is you smash that like button. If you're watching the replay, smash the like button. Leave a comment. I would love to hear from you guys. And as always, you know where to find me on Instagram at Mike Rosehart and on Facebook at Mike Rosehart. I have a blue check mark on both of those. So don't go find some other account that isn't me. I'm the one and only blue check mark. You'll find me, you'll know me. You see my stories there. I post 10 times a day. Come check it out. I look forward to connecting with more of you guys, and we'll see you next Wednesday. Like I always say, the secret to unlocking wealth. You're you. 3 levers in control your financial future. There's only 3 things you can do to better yourself financially. 1, spend less, earn more, and maximize returns in the difference. Those are the 3 levers. So you can control what you spend. That's the easiest lever to control. Then you can control what you make. You can get raises at work. You can pick up a side hustle, work evenings, weekends, buy a real estate rental property, find ways to generate more money. And then once you start making some money, the difference between what you're earning and what you're spending is your net, which goes into your savings. That investment account, if you have $0, if you have $100 in your investment account, it doesn't matter what you invest in. I have people reach out to me like, hey, Mike, I got $1,000, what do I invest in? I'm like, it doesn't matter. $1,000 times 10% return, times 5% return, times 15% return, it doesn't even matter. We're talking a couple dollars a year. Go work 1 extra hour this weekend. Pick up a side hustle. That's gonna make a big difference. Now, once your portfolio starts growing, what you invest in matters big time. If I make a 1% difference on my net worth this year, 1% difference in my portfolio, if I make a 10% return or 11% return, that has 6-figure impacts on my life. That's more than I spend in a year. So a 1% difference in yield on my portfolio has a bigger impact than in all of what I spend all year. So frugality is no longer important for me. Whether I spend $5 on a burger or $30 on a burger, it makes no difference at all, really, actually. It's not really consequential because it's such a small impact on the amount of growth I can have in my portfolio over the long term. So the 3rd lever is only important once you've built up your fortress of solitude. So you need to focus on earning more income. You got to focus on spending less. Super, super frugal to build that war chest. Once it's built, then let's talk about what you invest in. That's it for tonight. That's the secret to unlocking wealth through you. I could write a whole book just on those 3. I actually have a book mapped out on those 3 courses I had mapped out once. Haven't gone around to building it out, but I want to someday. I hope I get the chance to do it. Anyway, guys, we'll see you next week. Bye, guys. Next Wednesday.